Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, August 25th, 2022, and I'm pre-recording this Trading Places for just a little bit later this morning. Currently, futures are higher. We do have the Dow Jones futures up 127 points, S&P 500 futures up 26, NASDAQ futures up 100. So on a relative basis, we are seeing some leadership this morning in the NASDAQ, but of course we still do have another hour and a half, a little bit more to go before we open up. We'll see whether or not that holds. One thing that has held is crude oil prices. We got back up above the 20-day moving average, and they're holding there. Currently showing up 40 cents today, up over $95 a barrel now. So we are definitely trending back higher in crude oil prices here in the short term. And the 10-year Treasury yield yesterday hit 3.10%. It's down about 1 basis point today to 3.09, but that is starting to get a little bit problematic. We're going to see what happens as we head toward the next Fed meeting and as we head toward the next inflation reports. We got a couple inflation reports coming up in September. The August CPI and PPI will be coming out the first couple weeks of September. That's going to be a big report because they both came in way below expectations last month. And so another report like that would start providing the Fed some ammo and some data because they're now, according to them, data dependent, more data dependent. But that will give them the data to put the brakes on the rate hikes. So we'll see how all that comes out. But right now, the stock market seems to just be taking it all in stride as we try to recover off the recent selling. Before we get started today, let me walk you through today's agenda. So we're going to start off with the daily market recap. Then we'll jump into talking technically. Then I'm going to talk about manipulation in the market. I had a show, I don't know, maybe it was 2 weeks ago, talking about manipulation. Well, I've updated the spreadsheet. I'm going to talk just a little bit about that. And then earnings spotlight and the 3 you must see, and we'll wrap the show up. But let me take you over to earnings beats here. Okay, so if you go over to earningsbeats.com first, this is really important. Saturday, August 27th, 10 a.m. This is a free virtual event, but you have to register. So simply click on that link, and it'll take you to this page. I'll talk a little bit about, if you're unfamiliar with me and some of the things I've talked about here over the last few years, but especially this year with the bear market. I talked about the bear market before it began. Literally at the end of December, we had a market vision event back on Saturday, January 8th, near when the S&P 500 was at an all-time high. And I said, I thought we could drop as much as 25 to 30%. And the S&P 500 dropped 25%. Thought it might last about 3 to 6 months. It lasted 5.5 months. I believe we bottomed on June 17th. I got a video, I think on June 16th, calling it out on YouTube. I think all you have to do is go to YouTube, search, I'm calling the market bottom. I should come up. Trading Places live show. Anyway, the reason I bring all this up is because I'm going to talk about what I see going forward in the rest of this year and into early 2023. And I'm going to be using some of the same tools, techniques, signals that I'm going to explain to everybody at this event in order to make this forecast. So if you want to be there and you want to hear at least where I think the market's going, you want to make sure you sign up for this event. Saturday, August 27th, that's this Saturday, 2 days from now, 10 a.m. Just go in here, make sure you save your seat. All it takes is a name and an email address. The other thing we'll do is we'll add you to our free EB Digest, which is a 3 times a week newsletter. You can unsubscribe for that anytime. None of this requires any credit card, though. So anyhow, just make sure you go in, check this out. You can get more information here at this page, and then be sure to sign up. There are literally going to be thousands of folks at this virtual event. So you do want to make sure you save your spot. We're getting close to what could be capacity. So make sure you get your spot saved. And then again, if for whatever reason you can't make it, or you're not interested, but you still want to check out some of the things we do, if you scroll down, there'll be an area where you can just sign up directly into our EB Digest newsletter. All right, let's talk a little bit about what happened on Wednesday. So in this, excuse me, just grab some water. All right. So on Wednesday, in this daily market recap, you'll see the Dow Jones Industrial Average gained 59 points, S&P up 12, NASDAQ up 50, mid caps up 13, small caps up 4. Pretty good day. At least it slowed the selling, if nothing else. I think we're going to go higher from here. We're going to find out. I think one key I'm watching is QQQ that tracks the NASDAQ 100. I want to get through the 317 level. We got up to 316.87 yesterday. We hit 317 as the high the day before. So if we can get through 317, I think that'll start to encourage more buying coming in. Also, it'll take us above the 20-hour EMA on the hourly chart, which I think would be short-term bullish as well. Anyhow, yesterday's action was relatively flat, a little bit of back and forth action. Went up early, looked like we were going to take off, then came all the way back down. I think may have even gone negative for a few minutes, and then right back up, finished a little higher off of the intraday low. Looking at the individual sectors, all 11 sectors were up, all 11, which is kind of strange on a day when we really didn't gain that much. But anyway, everything was up. Energy led the way. It was up 1.23%. Then we had real estate, a defensive group, up about 4/5, 0.8%. Communication services gained about 0.6%. Financials up about 0.5%. And then the laggard yesterday, and I think this is the primary reason why the market was trying to go and never really got going. Technology was just flat on the day, just barely up. So technology is the most heavily weighted part of the S&P 500 and the NASDAQ. So if technology is not going, it's really going to be hard for these two major indices to do a whole lot of movement to the upside. So look for technology. And today, well, I mean, I think semiconductors could potentially lead, but we've got one obstacle at the open, and that was NVIDIA's earnings report last night. I'm going to talk about that a little bit later in the show, but that could be a headwind. If we can get beyond that and we can get the semiconductors rolling, it could be a sell on the rumor, buy on the news kind of a development for semiconductors. I don't know, but we're going to talk about that in just a minute. Anyhow, let's move on to the 10-year Treasury yield. Out this morning are a couple of economic reports. We're going to get the initial jobless claims. Of course, we always get those on Thursday morning. That's expected to come in at 255,000. Last week was 250,000. Until last week, we had a pretty good streak of continually seeing claims coming in higher than expected. Last week, we actually saw the opposite. We saw claims come in below expectations. So we'll see what happens this morning, but the estimate, 255,000. Q2 GDP, second estimate. Remember, the first estimate that came out a month ago was a negative number, minus 0.9%. That provided our second straight negative GDP, which now the government doesn't consider a recession. They're going to decide on their own what's a recession and what's not. All I can tell you is that when your economy contracts 2 quarters in a row, it's not good. Call it whatever you want. Doesn't happen very often. I don't think it's good. I think it's a recession. I think we're in one. But again, call it what you want. Use whatever definition you want. The second estimate is also expected to come in at minus 0.9%. So both initial jobless claims and Q2 GDP second estimate will be out this morning at 8:30. So just a little bit after this. Well, actually, you'll have it by the time the show airs. 10-year Treasury yield, like I said, is down. It was up to 310 yesterday. Came down this morning. It's not showing on this chart just yet, but it's down 1 basis point to 309. We're now up here challenging these two highs, and I consider that to be a relatively significant short-term resistance area on the yield. I think the bigger one for me is 325. That is only because for 11 years, we couldn't get through 325. We did it back in mid-June, but only for a couple of days, looked like a false breakout, and then right back down again. So 325, to go back up there a second time would start to maybe paint a little bit different picture. Now, here's the deal for me. I don't mind the 10-year treasury yield moving up. I don't think that is a massive difference maker in terms of whether or not the secular bull market continues. We're spoiled. This 10-year treasury yield, 3.10%, is historically very, very low. Any other time in history just about would love to have a 10-year treasury yield at 3.10%. So don't think for a minute that this, if we go up to 325 or to 350, that spells the end of a bull market. That's crazy. Rates are still historically low. You still have money that's very cheap. It just wasn't free, or it wouldn't be free like it was when interest rates were basically zero. The key for me is what the Fed does in terms of inflation expectations and what inflation does. I'm of the belief that it's temporary. It certainly has lasted a lot longer than I thought initially. I was wrong about that call. There's no doubt about it. But I still don't think it's a long-term. I don't think that this is a systemic issue. I think it's a pandemic-related issue. And there are those of you out there that disagree with me, and that's fine. Everybody can have their own opinion. But we didn't have any systemic inflation prior to the pandemic. Zero. We had no inflation issues. The pandemic came. We shut down the economy. Supply was cut off for a period of time. Demand picked back up. Supply wasn't ready. That's inflation 101 right there. Demand increasing and not enough supply. Too much demand, too little supply. Last two inventory reports, we're seeing inventories build. At some point, prices are going to have to come back down in order to unload inventory if this inventory build continues. So as the economy remains weak, that's kind of helping this pandemic-related inflation. Again, all this is in my opinion. I could do a whole separate show on it, but I'm just going to leave it at that. But my main point with the 10-year treasury yield is if you are going higher in yields from this area, it needs to be because the market is expecting better economic activity ahead, not higher inflation. Those are two different reasons for the yield to go up. One is very bad for stocks, inflation story. The other is excellent for stocks, picking up economic activity when rates are still historically low. Now, if rates do keep going up, I do think that impacts growth versus value, because growth stocks in a strengthening economy will do better, but as rates go up, that mitigates some of that earnings growth. It's not that they can't outperform. I just don't know that it'll be that surge that I'm expecting, because I think rates are going to go back down. And then I think the economy is going to pick up, and I think it'll be a nirvana for growth stocks. But if rates keep going up, then I would still be in favor of this secular bull market resuming, but it would be maybe a little closer race between growth and value. So anyway, that's the way I'm looking at all of it right now. Moving on to the S&P 500. So this is where we stand. Yesterday we came up, we failed at the 20-day. So 2 days in a row after closing below the 20-day, we've gone up and we failed at the 20-day. So this isn't rocket science. First thing you want to do if you're uptrending, you want to be above the 20. You want the perfect setup for stocks is price above the 20, then the 20, and then the 50. Because as long as that configuration remains, you're trending higher. It's hard to argue you're in an uptrend. So right now, there's a little bit of crack in the foundation with us being just below the 20-day. Is that a true, true break? Or is this just a temporary and, move below the 20 and then we shoot right back up again? I kind of lean toward the latter part. I know there's a lot of folks out there saying, well, September's around the corner. It's a bad month. Yes, historically, it is a bad month. It's the worst month, but it doesn't go down every year. And I think the market's set up to go higher. I really do. I don't think it's set up to go lower. We'll see what happens in September. But I think this is going to be one of those Septembers where we go up. Now, one thing that could change that opinion is if the end of August is so strong that we move back up to 43, 4,400, and we have a negative divergence on the daily chart as we head into September, that we could then see it maybe pull back or maybe more consolidation. But barring that huge recovery here in the next week, I suspect September is going to be a good month. That's, again, just my opinion. I want to point out here on this, let's take a look at the hourly chart on the S&P 500. We'll just go back, 3 months here. So what I'm seeing here is a low there. Here was a couple of lows right here. And here's a couple more lows right here. So that's where buyers have come in. During August, that has been the areas where we've pulled back and buyers have come in. Well, if you look yesterday, on the low yesterday morning, I sent this out to members yesterday. I thought we were going to rally off that low, which we did. We got back up to the 20-hour EMA and we couldn't get through. I think we're going to push through, though. Look at the PPO. So as we were going to this last low yesterday morning, look at the PPO starting to turn back up. So that's just a sign that short-term momentum is slowing to the downside. So the 60-minute chart, and we potentially could go down maybe just below 4,100 and still have this positive divergence in play and then bounce off of that. I don't think we're going to do it, but just keep that in mind. Let's call it 40.85, 40.90. I think this pattern and what I'm showing you here still is in play as long as we hold that 40.85 to 40.90 area. If we go much below that, I don't really see us stopping until 4,000. I think if we lose 40.85, 40.90, I think we're going to be down another 2%. And then that psychologically and from a price perspective would become a very important area with the 50-day moving average coming in just below 4,000. So there's some big numbers as you fall a little bit further for my argument that the bottom is in, because I don't even think we're going down for a double bottom. I don't think we're even testing that. I think we're done, washed our hands of it, and I think we're in an uptrend. But obviously, the further you go down and the more support levels you lose, the less reliable my argument becomes. I mean, I'll be honest. So much below 4,000, and I think 36, that low right there could come back into play. But again, I'm not calling for that. I don't think we're going to see that. We may be already at the low. It's going to be interesting to see how today plays out. And I'm going to show you an interesting thing here on manipulation in just a minute. So that's what I'm seeing with the S&P 500. Positive divergence down near support. I think we're going to roll back to the upside from here. One key to this theory, we've got to get semiconductors doing something. Yesterday, back down near the support area, near the 50-day, I would really watch the semiconductor index here, the DJUSCC, $ DJUSCC right here. But I would really watch down at 6,500 or so. Where's that close right there? Well, the close is 64.60. The 50-day moving average is 64.95. We do not want to lose those two levels. That would really begin to not look good because this is a pretty important part of the market. And even though it's still kind of struggling on a relative basis, semiconductors, when they catch fire, they can do it very quickly. And if you miss the move, you're afraid to get in because they're so swift to the upside. I mean, you can see back here, we were at what, 72.50? 6 weeks later, 97.50. 2,500 points. That was probably 37% or some 35% in 6 weeks. That's what this group can do when it gets moving. Now, I mentioned earlier, and I'm going to show you the NVIDIA chart in just a minute, but NVIDIA reported it's down. I'm suspecting that the semis are going to get off to a little bit of a rough start. But I think that, we've been going sideways here now for the last month. We've been in a downtrend all year. I think a lot of bad news is built into this group. So what I'm watching for is a stock like NVIDIA. If it does gap down, what happens from the opening gap? I don't worry about opening gaps. I mean, listen, I know it, big gap down, you lose money if you own it. But when I'm evaluating the strength of the market, gaps are one of the last things I look at. And let me show you why. Bear with me 1 second. I'm going to switch out this chart. I'm going to bring up an Excel spreadsheet. I did a special presentation on Trading Places Live a couple of weeks ago. If you want to see it, go to YouTube and search for Wall Street Thieves, Thieves, as in the bad guys, Wall Street Thieves. And I think if you search that, you'll see my video come up. Click on it, check it out. What I've pulled up for you here, I went back and I analyzed how the QQQ traded really back since November, middle of November of 2021. And I broke down the trading in the QQQ by the open, 10 a.m., 11 a.m., 2 p.m., and the close. Every day I did this since the close on 11/19. 11/19 through the end of December, that's when money was rotating, kind of rotating in defensive fashion. We were still going higher in the market, but under the surface, it was not looking good. So I wanted to start there. And then this is the change from the close, the previous close to the open. This is the change from the open to 10 a.m. This is the change from 10 a.m. to 11 a.m. This is the change from 11 to 2. And this is the change from 2 to close. So all I did, and then I total it by different period. 11/19 to 12/3, 12/6 to 12/8, 12/9 to 12/20. All the way, I broke down all these periods of here we saw prices falling. Here was a recovery. Prices falling. Here was a recovery. And I just broke down how the QQQ traded in each of these time frames during each of these periods. Okay. Now I'm going to fast forward all the way down to the bottom where I summarized each period. So this is telling me that the opening gaps of this period went up $3.51. That was right here. The next one was 420. There's your 420. So this is just a summary of each period from November through August. Now, I updated this all the way through 2 days ago. So this would have been through Tuesday's close. The QQQ during this entire period, I've got these checks in place, formulas to check the difference between the closing price on the 23rd versus the closing price back. I think this was, all the way back from November high. $88, the QQQ dropped. Added up all the individual periods to make sure I totaled the same number, which I did. And then here's the summary of all these periods, and there's your total. Just wanted to make sure, it's just a little audit to make sure everything's lining up properly. I want you to look at the opening gap that we've seen. We've seen the QQQs in total drop $88, but we lost $54 in the opening gap, $47 in the first half hour of trading, and $34 in the next hour of trading. Add those up, you'll come up with about $135. But wait a minute, we only went down to 88. Well, that's because from 11 to 2, we actually were flat. And from 2 till the close, the QQQ rose $48. Who in their right mind in a cyclical bear market, recession, inflation, who's going to be buying in the final 2 hours? Well, I guess anybody that wants to accumulate at cheap prices. When I looked back, what I call the distribution period, the primary distribution period in my mind was January 4th to the 27th. Every one of these periods was down. And even the last two, well, actually, this one was up a little bit, but 2 p.m. to the close down $28. That's selling. If you're a portfolio manager and you're trying to get out of 1 million shares, good luck doing it at the opening bell. You can't do it. You can't put a market order in for 1 million shares of a stock at the opening bell. There's not enough liquidity. You would get absolutely killed. That's not where the selling takes place. You've got to sell during the day. And that's why that period stands out like a sore thumb to me. That's when everyone was selling back in January. Remember the big, huge swoon in March to May 20th? Look at all this selling in the morning, all the way till 2 p.m. Look what happened in the afternoons. Wait a minute, who's buying? That was straight down, remember? We had buying. But here's the interesting part. This last move lower, this is a pullback. This is when the bears are really digging their heels in. Everybody's selling, right? $12.50 of the $19 drop was at the opening bell. This is manipulation. Look at amateur hour. Open to 10 a.m., down another $3.60. 10 to 11 a.m., down another $6.53. So once again, $22 or $23 of it was by 11 o'clock in the morning. What you don't want to do in a downtrend right now is be long at the close, because the opening bells are where you're getting killed, and early morning action. By 10:30 or 11, you should be thinking about going long. Even in this last pullback, everybody's, that's the end of the bull or the bear rally. And now here we go back down again. Well, tell that to everybody after 11 o'clock in the morning, because after 11 o'clock in the morning, we're seeing accumulation. Anyway, I'm going to talk about some more of this on Saturday. You want to be there. Let me just show you one thing on the XLK. This is technology. So technology went down $26 since November 20, or since that November 19th close. The XLK is down $26. Look at what the opening bell has done. We've gone down $31. How much selling has really taken place in technology? I don't think much. Anyway, let's move on. Talk more about it on Saturday. So earnings, let's do this real quick. Actually, we'll do this as part of the 3 you must see. So we'll combine the earnings spotlight with the 3 you must see. And let's take a look at these earnings that came out yesterday. So the first one I want to just point out is NVIDIA. That's a big one. So NVIDIA right now down 3%. So that is probably not going to get semiconductors off to a very good start. But as I look at the chart, 167 is going to be down about here. Very, very close to this low over here. Same look we had on the semiconductor chart. I am not going to be at all surprised if we see a hollow candle today. And the reason I say that, look at the AD line. This means that we generally see afternoon buying in NVIDIA. So we might have a little bit of a rough morning, but it might be the opening bell. Maybe it's 10 or 11 o'clock. If we're at a low, I would be surprised, really surprised, if NVIDIA doesn't come roaring back this afternoon. We'll see. Next up, CRM. This is Salesforce.com. Down $14. Not very good here. We got to be a little careful, right? $14 would take us all the way back down here to 165. When I see a stock, gap down that close to support, my guess is it's going to go the rest of the way. So I'd be looking maybe for a 156, 157 test here on Salesforce before I would get interested. By the way, Salesforce beat by a mile, 119 over 102 on the earnings. NVIDIA missed, came up short, 5 cents short, 51 cents versus 56. So good reason for that one to be down. The other one I wanted to mention was Williams-Sonoma, which has been a very good performer coming off of that June low, double bottom on Williams-Sonoma. Stock up $5. Looks like it's trying to break out again. I'll just give you the number that I'm watching. And that is, I want to see a break over 168.87. I'd like to see it on the open. We'll find out. Anyway, that's it for me today. Appreciate you tuning in. Please, please make sure you join me on Saturday. This is going to be a huge event. I'm going to give you where I think we're going the rest of the year. I've had a pretty good track record. I don't know anyone who's called it better than me this year. And I'm just being honest. I'm not being cocky. I'm just being honest. I've nailed the tops. I've nailed the bottoms. And I think I have a pretty good idea where we're going the rest of the year. Make sure you register. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.